welcome to Struggles of the Spirit. I'm your host, as usual, Lee Udell, and I'm glad that we're together again. It's always special for me to be with you people, and every once in a while, a neighbor or a friend or even a stranger says, I know who you are, and, and suddenly we have a connection because they have seen Struggles of the Spirit, and they associate it with me because I'm the host. And it's fun to do that, to have a prior connection with people, one you didn't even know you had, and so I enjoy it. So today we have a guest here, Pat Thornton, who is a financial advisor. He's been a friend and a colleague for a number of years now, and he's a good man to have around. And we're going to talk about what he does for a living and how he and people of his background and interests and skills might help you in one way or another. But first of all, please remember, this is a phone-in show. Unlike commercial television, you can't phone in and interrupt, well, in the old days, Johnny Carson, but I'm dating myself, but you can't interrupt whoever the celebrity is and put in your 2 cents. And make your question or your statement evident and obvious and emphasized. You just have to just sit there at home and watch and shut up. You have no chance to say anything. But here you do. Here we want you to say things, and you can be on our show, and we can hear your voice if you call our station. We have a phone number just for the studio. Not for the VCAM altogether, but just for this room. And can you help me here, Pat? The number is
651-0589.
651-0589. And if you call that number, Bill, who organizes all of this, he will get your call, and then he'll plug you into our loudspeaker here, and we'll hear, Pat and I will hear your voice on the loudspeaker, and then you'll hear us because we have mics on, and the mic will directly go to your ear through the phone service. So it'll be like you were here, except we can't we can't see your reaction. There's only with speech. We don't have any way to have you visually available to us, but we do better than commercial television, at least. So please participate with us, and you don't have to be a wizard or a skillful person. Whatever you have on your mind that you would like to share with us about financial investment, well, retirement for that matter, I guess, as well. Please phone in and give us your thoughts, and we'll listen to them and repeat them so that the whole public can hear, and then we'll answer them as well as we can. So we await your call. And if you're watching this on a taped show, because remember, the only live show that we do is on Wednesdays right now from 11:30 to 12:30. And if it's a taped show, then it's 3 other times it's on. But we're not sitting here continually day and night for those taped shows. The only way you can communicate with us is by using our cell phone address. And the cell phone address is on your TV screen at home underneath the picture. You have to have a computer to do a cell phone, what do you call it?
Email
message, but we're happy to receive that message, and we'll get back to you however you ask us to, a phone call or a letter or email as well, whatever your desire. So please contact us one way or another, either audibly on the telephone right now, or else by email at your leisure, and we'll get back to you. So how would you describe what you do, Pat, for a profession, for a livelihood?
What you're working with is individuals or families or organizations. And what your job is to advise them based on their needs, their ability to take risk, what their goals are, advise them how to invest their money. That's just about as simple as we can put it. And it's interesting because that role is an evolving role. You know, I've been in the business 25 years now, and I think the traditional model was a broker was someone who sold investments to people. Now the role is much more of an advisor, and I think that's a better model for everybody. I think it's a better role for us to play than trying to sell them on the latest new investment.
I would suspect that trying to sell someone on the latest new investment is not always unbiased, and it could be self-serving because it might be an investment you're behind and you're trying to get investors in that product.
Exactly.
Yeah.
I mean, in the old days, on a commission model where you had someone invest money and you received a commission for it, it was much more, unfortunately for everyone, it was more of a sales position.
Yeah.
Nowadays, you're looking, and there's new ways of compensating advisors. Now it's more trying to manage someone's account, manage their portfolio in a way that meets their goals and their risk tolerance, and you're paid to do that, to advise them. And it's basically, you know, I think the way to look at it is you've moved from across the table to their side of the table.
I like that.
And now you can work for them instead of trying to convince them of something. And I think that a lot of the big investment firms are coming to that idea now more and more, which I think is great for everybody.
Why is it that a lot of people are afraid of any kind of investment, like what you do or large investment corporations do?
I think there's a fear of the unknown all the time, no matter what we do. You know, if it's going to the doctor, you're afraid. When people come to us, they're afraid. Probably the greatest fear I think out there is this fear of they're going to be taken, that they're going to be taken advantage of, and that only comes about. That's only changed through trust and time, you know, as you know. And I think that the other is the fear of the unknown. You know, I don't understand this, so I'm not going to deal with it. And unfortunately, you kind of have to deal with it. You know, more and more. I mean, I think the greatest example of this, Lee, is in people's retirement plans. You know, 401k plans and 403b plans, and people are investing money, and they're going, I sure hope I'm doing the right thing, but they don't really grasp it. And so, hopefully, that's changing. The danger of it not changing is that someone accumulates an awful lot of money over time, receives their distribution from their company's retirement plan, and now they have to manage all this money and have no idea what they're doing.
Oh, yeah.
And you see a lot of abuse in our industry where people come in and they'll say, I can help advise you on this. And there's, no matter what you do, whether it's buying a new car or having your house remodeled, there's certain things you need to do when you do this. You need to talk about experience. You need to talk about cost. You need to talk about how's the advisor getting paid and how much they're getting paid and who's paying them. But once you can get that trust built up, it's a great relationship. You know, I mean, it's one of the nice things about the job is to get to know families, know what their goals are, know, you know, who the family members are and how they all work together. And that's kind of a neat part of the job that people often tend to not realize when we do this.
Well, this guy here, dear viewers in public, he helped drive my wife home from the hospital when she was ill one time. How do you like that, huh?
That was a good trip we had, wasn't it?
It was.
Yes, it was.
That's not a usual stockbroker role.
Well, but it gets back to the point of trying to, you know, when you know what's going on with a family, there's certain things you can do to help. And I wouldn't say it was the smoothest ride home, but we got everybody home, didn't we, that day?
No problem.
Absolutely. So that kind of part, and that's a very satisfying part of the job. You know, I think one of the things that sometimes people don't always realize is that your client's goals become your goals too. It's much more fun to say to someone you're making money than to say to them, unfortunately, you're losing money right now. And sometimes it's out of our control. As you and I have talked about,
sure.
There's, if the markets aren't going to help you, sometimes you're going to lose money. And hopefully it's only in the short term, but you become connected to your clients. You become connected to your families, and you want to see them make money. You want to see them achieve their goals, and that's a big deal.
Let me ask you, this is a loaded question, obviously. So warning. Do you ever tell your clients you ought to sell these securities now?
Yes, you do. I think one of the things that's interesting is never fall too much in love with any one investment. And the other thing is sometimes you got to sort of park your pride at the door. I would be the first to tell you that in 25 years, I've picked some bad investments for people. And rather than keep holding on, sometimes you got to go, you know what? This isn't working out. And I was wrong. And we're going to get you out. And sometimes that's a great relief to a client. Now, I'd love to say all clients understand, but some clients remember that for years. But it's part of the job. And you never become too enamored, because in our business, it's a very cyclical business. It's something that can make you a lot of money. Sometimes you have to say, the party's over, we need to get out. And it gets back to this whole compensation structure. When you're being paid to advise somebody and not on commission basis, I think a client is much more willing to say, yeah, because they realize you're not being paid on the sale of that security. You're just being paid to advise them. So I think it's a cleaner relationship, and it's much more satisfying when they have, in effect, hired you to be their advisor for them. And it brings a lot into play. But yeah, there's times you have to say it's time to get out. Now, sometimes you can say it's time to get out because you've done great. And other times it's okay to say, you need to get out because this is a bad situation.
I remember, I don't think you were my broker at that time, but I remember, there was a well-known company that was a Canadian firm, Bombardier.
Yes.
And they were making big money.
Yes, they were.
And I remember my broker, I think that was David at that time, said you ought to sell, because I don't think they're going ahead as well as they used to.
Yeah.
And so we sold, but I liked the company so that I kept a certain percentage, still owned it. And I have no idea whether they are making any money now or not.
I don't know. It's that's sometimes a very hard. It's wonderful when you're making someone money, but your other goal, and I think it's a more important goal sometimes, is to minimize the damage when the markets are going down. I think a good broker is willing to give up something on the way up to protect you on the way down, and there's reasons for that. I think one of the most interesting parts about what we do is the emotional component, the emotional factor of investing. And a lot of times people say, I don't need a broker, I can do this on my own. And you say, yeah, you might be able to. But sometimes you need somebody to tap you on the shoulder and go, this is a problem, we've got to do it. We've got to get you out, or we've got to get you into something. And there are all kinds of studies, and there are actually universities that have departments that look at the emotion of investing. And I always remember there was a great quote by some, I forget his name, but he won the Nobel Prize in economics. And they said, why do you like economics? He goes, because it's so close to psychology. And he said, you're dealing with human emotion. And that's what drives markets. That's what makes things go up and down, is human emotion more than anything. And the worst and the ugliest human emotion of all is greed, because greed gets us all in trouble in one way or another. But it's interesting to watch how people respond when markets move. And they tend to think they're thinking rationally. Sometimes they're thinking irrationally and very emotionally about what's going on too. Well,
I've always said that I think the farmer is the biggest, maybe that's not the right word, but it's the person who really has to trust a lot and is a gambler to some degree, even more than somebody who owns stock, because you can have a great crop out there and then all of a sudden it can get all ruined.
Absolutely.
If the weather changes, or you don't get things harvested because of rain, or, I mean, there are no guarantees in life, no matter what you're doing.
They're not, and as you were saying that, it was interesting to me because you can think of, what's the greatest potential problem a farmer can have and the greatest potential problem someone in my business can have, and that is to start to think that you're really, really good at this, and that you have a great crop, and you say, I'm a great farmer. And there might be a component where you're a great farmer, but the weather cooperated, the markets cooperated, your help cooperated, all things came together for a great crop. And I think the danger in someone in my business is you can have a couple good years and start to think, I can't lose money for people because I'm so good at what I do. And it's a very humbling experience because normally when the markets go down, it's after 2 or 3 years of really good experiences and you go, I'm really getting good at this. And that's it's very dangerous to be thinking that way.
Yeah. I was born in 1930, and my father impressed upon me about the dangers of the market because
Yes.
there was this, as you well know, this huge depression which affected everyone's lives in this country. And so I grew up not distrusting the market, but being very, 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 very aware of how
Yes.
devastating it can be.
Yes.
And I've seen some statistics about how many people were out of work. It was amazing.
It's staggering. And what's interesting is to watch generationally how different generations look at investing. And there's clearly that generation that was exposed to the Great Depression, were growing up during the Great Depression.
That's me.
And their risk tolerance is very different than someone who is maybe 20, 25 years old.
Yeah.
And you have to take that into account.
Yeah.
Sometimes, the most important thing is to respect someone's risk tolerance. How much risk can they accept? And because if you try to talk them out of it, they're probably going to go home at night and go, he made a lot of sense or she made a lot of sense, but I'm still scared. And there are times when you have to respect that risk tolerance that you're hearing because they're saying, I know I could make more money. I just don't want to lose any money. And you have to respect that.
Yep. It's as you know, my experience hasn't kept me from investing.
Yes.
But it's made me cautious, and my caution was emphasized when in the 19, I guess it was the early 60s.
Yes.
There were some investments that I entered into by selling some of the cash value of my life insurance and taking that money and buying some stock, and it lost money.
Yeah.
And it went down and down and down. And then the real bittersweet thing was that after a few years, my insurance company said, no, you got to
Pay up. Yeah.
with interest.
Oh.
And I really lost a lot of money.
Right.
Because it wasn't just that I lost money on the stock market, but I lost.
You had a double whammy.
I had a double whammy. I had to repay my insurance company. So.
I think one of the rules that you constantly want to be aware of in all this, and it's an old adage, but it's true. If something sounds so good to be, it's too good to be true, it probably isn't true. And
Yeah.
there's not a day that goes by when someone says to me, why don't we take this risk? This sounds like a good risk. And sometimes you just have to hold someone's hand and go, this is not a really good risk. You're taking way more risk than you should. Because I think human nature says we look at the upside. Most people tend to look at how much money can I make? And if you're going to do that, you've also got to do how much money can I afford to lose? And for how long can I lose it? And there's all kinds of...
That's a scary question.
It's a terribly scary question. And there's all kinds of questionnaires to sort of measure risk tolerance. And what they really get at is how long can you take a loss? Can you take a 3-month loss? Can you take a 6-month loss? Could you take a 3-year loss? And that really tells a lot about someone. And that is when you as the investor have to be very as honest with yourself as you can. Because a lot of people, will come and say, oh, I can take I could take a 10% loss for 3 years. Then you think, maybe you can't. Or can you explain that to your spouse or your partner that you're willing to take that big a loss for that period of time? And that's, that's a whole nother issue of investing, which I find to be interesting, is how couples interact around investing. There always tends to be one who's willing to take some risk and one who's not willing to take some risk. And I have seen very animated conversations between couples about how much risk they should be taking.
Animated,
Very
I like
animated,
that.
extremely animated, to the point of saying, maybe I'm going to go now and let you two figure this out. But it's and you know this from your work, how money can enter into a relationship and hinder a relationship. And I'm not sure people have to change, but they have to respect what the other person brings to the table with respect to risk and their goals financially. And what's interesting about this is everybody thinks sort of what's the standard for making money. It's really, if you make 8% a year in your retirement accounts, and we're not talking about 8% year after year, we're talking about an average of 8% of probably over 5 years. That's all you really want to try to achieve. It always scares me when somebody comes into my office and goes, if I can just make 15% a year, and I want to respond, if I could just make 15% a year, we'd both be fine. But make your goals realistic. That's the most important thing. And as a nation, as you know, we're not a particularly good savers.
No.
As opposed to the Japanese and the Western Europeans. And that's something we have to do a better job of. But set realistic goals, like 8% is all you're really looking for. That'll do just fine.
That's a small amount, it sounds like.
It is, but we go through these years where everybody gets 2 or 3 years of double-digit returns. Well, it's like great markets are like great parties. There's going to be a time when it comes to an end. And you have to be prepared at that time to accept the fact that you've done well, and now you might have to go into a little hibernation here and protect yourself.
Well, I think we've told you when we first met you, my wife and I, that we got some very good advice from a friend who told us what you want to do is you want to have some investment in the stock market because you want to keep up with inflation.
Yes.
You need that. If you just have bank interest, it's not enough.
Mm-hmm.
Or, and then he suggested that the way we got something that was secure, that would not go up and down very much at all, would be bonds.
Yes.
That's the safe way to go. You don't make a lot of money, but you make some money. But it's safer than the stock market.
It tends to be.
And so he would say you want to have both kind of instruments, one stocks to keep up with the market, and the other with the bonds to save your buck if the market goes bad.
A great client that I had many years ago was a farmer, and he said investing is like manure. The more you spread it around, the better you do. And I used to use that picture all the time until one of my clients said to me, yeah, but it still smells. But I said, it's okay. But the truth of it is you never make big bets. No matter what you do in life, try not to make too many big bets. You never want to be in a position in the investment where you say, this one investment has got to come through for me. Because we don't know. I mean, I can tell you the times when you do research and you're looking at an investment going, this looks really good. And you're ready to put your clients into that investment, and it goes south. And it goes south for reasons you didn't know about or you couldn't anticipate. But the people that worry you are the people that are doing well and then push to do better. Sometimes it's like life. Just go down that road and stay calm about it, because you really get yourself in trouble.
Say that again, Pat. I think our viewers might want to hear that again about your advice.
Well, you want to diversify yourself enough. And diversification, means just purchasing enough different investments. So no one thing can hurt you. No one thing can really ruin your investment account. And I don't care whether you have $2,000 or $2 million, is spread the risk around. And any advisor that is worth their weight is going to tell you the same thing. You know, you go to, I'm sure in your work, you know, you go to a conference, and you always go to a conference expecting to hear something new, and what you normally hear in our business is diversify, keep people diversifying. And I can tell you the number of times, I can't tell you the number of times people have said, you know, we've got 5 different investments in their account, and they go, this one's doing the best. And they go, why don't we put all the money into that thing?
Yes, that's the question.
Yeah. And you say, no, you don't. And I tend to be someone who likes to paint pictures for my clients. And I, you know, my approach always is, you know, you're look at an investment like a party, and you're sitting across the street and you're watching the neighbors get ready for a party, and you're going, well, it looks like they got a band, and it looks like they got, you know, they're bringing in a caterer. This might be a good party. And your husband goes, we're not going to go to this. And then after a couple hours, you go see everybody going in, and you hear the music going, and everybody's having a good time. And finally, after 2 or 3 hours, you decide it's time to go to the party. And usually, what does that mean? It's the end of the party. So when you see an investment doing really well, you say, boy, all my friends are making money. That's fine. Let them make money. It may be too late for you to get into the game. But don't let emotion drive you into that, going, boy, my friends just told me about this thing they made 30% in. And it's a classic case in some of the markets right now, is that some things have done incredibly well in the last year, 2 years. Well, now you've got to gauge, can you see a scenario where this is going to continue, or is this going to start to slow down a little bit? And one of the hardest parts about my job is normally you want to put someone in an investment that's doing really badly. You want an investment that's doing badly, and the reason is because you think it's going to start to do better eventually. That investment that's done great, it's going to have to slow down at some point. And you just don't want to be there at the end of the party. You want to be there at the beginning of the party. And that's a very hard concept to preach to people sometimes.
Yep, it is. It is. Well, I'm retired now, basically, and I think I told you that I being a clergyman, that my retirement money comes largely from the church.
Yes.
Nationally, not from local Vermont, but
Right.
nationally. And the national investment committee for the clergy nationally, we bought eBay when it first came out. And we made a lot of money
Yes.
on eBay.
I bet you did.
And the unusual thing about the church is that they passed the lucrative returns back to the clergy.
That's wonderful.
They didn't just, make their palace greater,
Right.
or give themselves a higher salary.
Right.
They must have given themselves some sort of raises, but the clergy who were in retirement got a bonus because of eBay.
Yeah.
And I think that's awesome. And I wonder how many other retirement programs do that.
I don't think, what's happened, you were in a plan that was more the norm of 40 years ago, what's called the defined benefit plan.
Yeah, well,
And the defined benefit plan paid you a uniform amount of money over time for the rest of your life. And you pretty much know you can go down to your mailbox on a certain date every month and you're going to get a check from the organization.
we had a prominent leader of that retirement program called J.P. Morgan.
Yes, I've heard of that. Yes. Of course, you don't want to lose money for clergy. You never want to lose money for the clergy, do you? I mean, that just says a lot about you. But those plans have, for the most part, disappeared because they're so expensive and people are living so much longer. And so now you have what are called these defined contribution plans, also known as 401k plans or 403b plans if you're in a not-for-profit organization. And the impetus is on you to save some of your money. And it's wonderful. I think one of the most heartening things is you find somebody in their 20s who've started to have some money built up there, where they've built up some cash, and they're good about saving their money. And I just think that's the most reaffirming thing is they realize you've got to do this now. And it's so much easier to do it now, and you can save so much more if you start early. And one of the things that's interesting is this always used to be a voluntary benefit at a company, where if you wanted to get into their retirement plan, you went in and you had to sign up and enroll and tell them how much money. Now you see a change, and the change comes about where now some companies are saying, we're going to assume you're going into the retirement plan. So you are in, and you are in at 3%, and you're going to put this money in unless you opt out, unless you actually sign the documents and say, I don't want to do this. And what it's done is it's pushed up the enrollment rates for younger people, because now they're saying, well, the company says I should be in this, so maybe I should do it. So you've got this sort of statement by the company that says we believe in this, and you're seeing people take a much more proactive approach about their retirement because they know it's not going to be there unless they save it at the end.
Mm. It takes a lot of discipline to. It
takes an incredible amount, and it takes particularly in the early years for two reasons. The first is most people when they're right out of school don't have much money.
No, they don't.
And they're looking and saying, let's see here, do I want to get a new sweater or do I want to put away money in my retirement account? And you know that in fairness to these people, that's a tough decision. And the other part is I'm not going to realize this money for another 40 to 45 years.
Right.
And who knows where I'm going to be, who knows what I'm going to be doing, so I'm just not going to do it. I'll start this when I'm 30 or 35. And when they get to 30 or 35, now they've got a whole new set of problems. Now they have 2 babies, and they need a new car, and then they put it off, and eventually they put it off so long that now they don't even get into it because it's just not worth it for them. And it's a very tricky scenario. And that's why more and more companies are really making a strong push to get people into their retirement plans. And not only save the money successfully, but learn how to manage it, because at some day, as I said earlier, they're going to have to know what to do with this money and how to avoid either getting taken or losing large amounts of it. Both of those are big problems.
I keep waiting to hear the phone ring from somebody viewing our program today.
Yes.
But I don't hear any phone ringing.
Well, it's 2 of us, so we're okay then. So,
Bill, any phone ringing there? Not yet. Our station manager says not yet. Some of you must have a need of money who are watching this program. Give us a call. Your thoughts, your fears, your wishes, your anxieties, your comments, please give us a call. Tell them again, if you would, Pat.
It's 651-0589.
Pat Thornton is our financial advisor who is here today, sharing with us his experience and knowledge. Pick his brain. This is struggles of the spirit. Your spirit gets...
It is a struggle.
Oh, it is.
It's there's so many couples today that are tight on money, and they're saying, I can avoid doing this now, and I can get this for my family, or I can, take better advantage of daycare, or get the car fixed. And it's a very tough balancing act to say, no, I'm not going to do that because I really need to put money away from my retirement account. And everybody's, you just know it. And there's also that big thing to deal with is the fear of the unknown. I don't know how this works, or I don't know enough about what I'm doing to be successful at it. So I'm just not going to play the game at all. And and I always find it very refreshing when someone comes to you and says, I give a lot of talks. I give a number of talks a year, maybe 100 talks a year.
Wow, it's quite a few.
Yeah, it's quite a few now that I'm thinking of it. And what's interesting about it is you'll say, does everybody understand this? And you've spoken to groups long enough, and everybody will nod their head, and you go, I know there's a bunch of people out there just nod their heads that don't know what I just said or don't understand it. But there's nothing better than to start the conversation than for someone to say, no, I don't understand. I still don't understand what's going on here. So can you help me with it? And that's very satisfying because now you've got a baseline. Now you've got a place to start with someone. And it's not the most complicated thing in the world. We hear stuff, we read stuff, we see stuff on television that makes it sound very complicated. But what you really need to know is what a stock is. You need to know what a bond is. You need to know how mutual funds work.
Do you want to define those terms now?
Yeah, I would be happy to. You know, a stock is simply ownership in a company. And you are participating in one way or another, either positively or negatively, in how that company is faring. And so you can buy, you know, a share of stock in tens of thousands of companies. There's probably about 12,000 companies you can buy stock in. And typically, you're making money in that stock when either that company's either doing well or there's the perception that it's going to do well. Everybody thinks it's just a tie in how it's doing. People buy stock because they think a company's going to do better. Bonds are interesting, Lee, in that a recent study showed that about 40% of the population does not understand what bonds are. And it's a very, very simple explanation. Bonds are debt. When you purchase a bond, you are loaning your money to someone. Now, what form does that take? If you go into the bank and you want to get a CD at the bank, that's a loan. You're loaning your money to the bank, and they promise to pay you back all the money you gave them, plus interest. And interest could be any amount of money, depending on where interest rates are at the time. But right now you can probably get 4.5% on a short-term CD. And that beats what you can get in your savings account. So bonds are debt. They come in the form of CDs. They come in the form of treasury bonds, which you've heard of. They come in the form of municipal bonds, which are sort of a subset of all that. Corporations issue bonds. Everybody is trying to raise money. If you look at it, what do stocks and bonds have in common? The issuer of the stock or the issuer of the bonds needs money. A stock is he's going to sell part of his business. A bond is he's going to borrow money. And that's what the difference is. The other question that comes up all the time is what's a mutual fund? And a mutual fund is a great vehicle for someone who, one, admittedly may not be as sophisticated as they'd like to be. Two, they're putting money into the investment markets all the time. And what they are is there's three components. They're managed. Someone is managing that money for you around a certain theme. If you're buying the Fidelity International Fund, it means you're buying stocks from around the world. Excuse me. That's what his job is, to pick stocks that he thinks are going to grow from all around the world except the United States. Secondly, it's pooled money. Your money's going into a big pool that's being managed. Some of these mutual funds today have $50, $60 billion in them. And the last thing is they're diversified. The minute you put $1 into a mutual fund, you own little bits of hundreds of different companies, which is a good thing. If you're a novice or just getting in, you're much better off going into a mutual fund than buying a share of stock. Because what you're doing is you're making a bet on one company. And that's admittedly a much bigger gamble than if you're putting money into a number of companies. And if you watch how some of these mutual funds have done over time, they do great. Mutual funds are the best accepted and the best vehicle for these retirement plans if people are having to pick them. What they should be aware of, however, is if you're in a retirement plan at work and you have all these investment choices, most plans have someone you can speak to give you advice. So what you simply want to do is go to your HR director or the president of the company and say, is there somebody out there that I could be talking to about what to do with my money? And in most cases, they'll say yes.
Complicated.
It's complicated in the respect there's a lot of choices, but when you break it down in what's a mutual fund, And I think the mutual fund is the most accepted vehicle for investing. CDs are also a very well accepted vehicle for investing.
I personally didn't do very well with mutual funds. The theory is that they're safe because there's a variety
Yes.
of investments spread around the area, but I don't know.
Well, you know, the problem so many times in any investment is we have to do just the opposite of what we think we should do. You know, when you see something going up, what's your natural impulse? Is to put more money into that thing. And what happens when you see something going down? You want to take all your money out of that.
Right.
And in a lot of cases, it's just the opposite. You know, it's interesting to me because for those people who have invested for years, you know, the late 90s were a great time to invest money. And, you know, one of the reasons the market went up during that time is because people kept investing more money. And when you put more money into investments, it makes those investments go up. So as a result, it made the market go up. And then you get this sort of emotional response where you're gonna bet the ranch. And then people start getting irrational. And that's sometimes, you know, you talk about what my role is. You say somebody, you go, is this something you really want to be doing? Because it may not be such a good idea for you.
Well, wanting to be a responsible investor and a responsible person, I'm always puzzled, and I think a lot of people are, when you get something from the corporate headquarters saying that there's an election coming up for new
New
officers.
officers or board members.
And I don't know them from Adam by and large.
Right.
I don't know whether they're good or bad or whatever, and I always feel confused as to what to do.
It's, you know, it's worth looking at, but what they're doing is they're adhering to the legal process where you have to get a vote.
Sure.
And if you have 100 shares, you're going to get 100 votes. Now let's put this in context, though. Say you own 100 shares of General Electric. You're going to get 100 votes, and there might be 6 or 7 billion votes out there altogether. And sometimes certain groups own big blocks of that 6 or 7 billion, so they can really swing a vote. But what it speaks to too is this sort of corporate governance, where people are playing a bigger role in looking at how companies are run, in making them more accountable and responsible for what they do. I'd love to tell you your 100 votes might swing a vote, but the problem is what you said too, is that a lot of times you don't know who these people are. And that makes it really difficult. I don't have any answer for that. I'm not sure what to do. You know, you can be very, very vigilant and do all the research. Or you can just say, you know what, is it worth it to me to do it? I don't know the answer to that. But most people I know will take that information and dispose of it very quickly, whether it's fortunate or unfortunate.
And dispose of it, I mean, throw it away.
Probably throw it away. Probably put it in the recycling bin is what they're going to be doing with that.
Yeah, it's hard to know what to do.
It is, and this is where, you know, we've come full circle to a certain extent. That's why people have advisors. That's why, you know, people call you up and say, what should I do with this paperwork? And in some cases you might say, well, we need to read it, I'll come out, we'll go over it. Or you might say, you know what, you can throw this out. The other thing that comes up all the time is the class action suit that a company is going to pay off on. And a lot of times you'll get something in the mail, go, do you want to participate in the class action suit?
Yeah. And
one of the things you have to do in this is get a sense of how much money you're really talking about. Are you talking about thousands or hundreds of dollars, or are you talking about $6? And you know what I always advise my clients is say, what is your time worth on an hourly basis? Is it worth it for you to fill out this paperwork for the next 40 minutes knowing you're going to get $5 back? Now, to some people, they go, yes, I'm just doing it because they owe me the money. And then there's others that go, I'm doing it because it's a sizable amount of money. Each person has to decide that. But I do think this whole question, there's a progression in the way you think. You know, there are sometimes people come say, I don't need an advisor. And you go, that's okay. Maybe you don't. And there's others that say to you, I need you to do this work for me because I don't want to either get involved because I don't have time or just because I don't know. And I would say the vast majority of people in my industry are good, concerned, conscientious citizens and do their job very well. But with any business, there are people that are looking for the compensation without doing what's right for the client. And that's why, first and foremost, when you're picking an advisor, you want to know what they've done, how long they've been doing it, and how they get paid. How am I going to pay you? And I think one of the great red flags is you don't have to worry about that. I get paid this way. It doesn't affect you. Yes, it does affect me. Just tell me how it does affect me. And I think a lot of people, you know, get into that process and they go, I'm not going to ask any more questions because I'm going to look bad doing it. But it is important to ask, how do you get paid? How much will you be paid? You know, I want to know all the fees. And not because I'm not afraid to pay them. I want to know what I'm paying when I pay you.
Yeah, that's quite wise.
Well, I'd love to tell you I knew it 25 years ago, but you kind of learn over time. And I do think it gets back to what you said earlier, too, and that is, you know, probably one of the very most satisfying parts of the job is getting to know families. And, you know, before we came on the air today, we were talking about your family and your wife and your children. And the people that I know in this industry do care about the families they work with. I mean, you want to see them be happy, you want to see them realize their goals, and you want to help protect them more than anything in the world. But I think the way you as a client can protect yourself, too, is always to ask certain questions.
Like what?
How much risk is this? How much risk am I taking here? What's the downside to this investment? What might happen to this? How do you get paid? Who pays you? And how much? There are ways in our industry, Lee, where someone can look a client right in the eye and say, you're not paying a dime. Now I would love to tell you I do volunteer work in my job, but you don't. You have to be compensated like anyone else has to be compensated. I'm providing a service for you, so just tell me what I'm paying you for the service. The third thing is not discussed that often, but I think it's important, is what's the accountability factor, or what can I expect from this relationship? Am I going to meet with you twice a year? Am I going to meet with you 4 times a year? How often do you anticipate coming to my house or me coming to your office to get some of this done? And I think you as a consumer have the right to say, I need to know these things before I make a decision. And I think that's really important. Another way to protect yourself, and this is for people who use accountants, is have your accountant meet this person. Say, what do you think of this person? Do you think they're on the up and up? Now, it might cost you $50 or whatever, but it's probably money very well spent because you know your relationship for your accountant. You know that they're looking out for you because you're paying them that. And I would much rather have someone tell me, here's what I'm going to charge you, and I'm going to do these services for you, than to say, don't worry about the cost, I'll take care of it. Because they're not. They have to get paid somehow.
Yep.
And I think the accountability and the service issue, too, gets a lot. How often are we going to meet? And what are we going to talk about? It's very satisfying to help solve people's problems and to meet their goals. So have some goals. I know, there's and I hope I'm quoting right, there's a great study from Yale University where this professor wanted to talk to people. He asked the graduating class, every member of the graduating class one year, do you have any goals in life? And the number was about 25% who said, yes, I have specific goals that I've written down that I hope to achieve in the next 30 years. And then he went back and found as many of these people as he could. And those that had set goals just did better. Their life were fuller because they were trying to achieve certain goals in life.
That'll do it, I hope.
Yes. Well, everybody's wired a little differently, but I think there's some common threads, too, that you can say that that's something that's important. And I think one of the things that's interesting when you invest money, one of the first questions I always ask is, what's this money for? Is this money you're going to use for vacation, for retirement, for college. Tell me what you want this money to do for you. Because you could have a client with 5 different accounts, and each one of those accounts is serving a different purpose for that family. So you need to be able to articulate that back to the client, say, this account is for your retirement. This account is for your trip to Florida. This account is for your children to go to college. Each one of those you should know what the purpose is and not blend them all into one, because it's not productive for the client. So that's an important relationship when you know that. And the other thing is to constantly weigh in and ask them, have things changed for you? Do you see a change in what's going on right now? And if you can do that, that really accomplishes a lot. We tend to look at a lot of our clients every 3 years and say, let's look at your goals again and see if things have changed a little bit. And once you get that conversation going, it goes pretty well. So, and that again is a pretty satisfying part of the business. Other things. Here's another rule that I think is importantly is a lot of times families are torn between saving for retirement and saving for college. And I think the rule of thumb here is save for retirement first, save for college secondarily. There's a lot of ways that you can, through loans, through grants, through scholarships, that you can help finance someone through college. But unfortunately, they don't offer an awful lot of scholarships and grants and loans for when we retire. And the other issue that's made it more poignant is the fact that as people retire, they're living longer now. And that danger is to be healthy and older and becoming broke, which is, I think, a big fear that the government has and a lot of companies have. So that becomes a big, big issue now, is how do we make sure you've got enough money? Now, everybody's going to work longer, but we also want to make sure that, the anticipation is that you're going to work, for a longer period of time than maybe your parents did.
Right. Yep. How are you doing time-wise?
Time-wise, we've got about 8 or 9 minutes left.
Do you have some questions you want to ask me?
I think over the years you've answered all my questions, which has been great. But I think that the important thing, and you and I've had this conversation before, and I'd like to get your thought. I just think emotion plays a very big role in how people invest their money, and they need to be aware of that. They need to be aware that their emotions are coming into play, both rightly and wrongly. Sometimes it's good to say, that makes a lot of sense, but I can't buy into it because it scares me.
Yeah.
And the other time is to say, I know I can keep this all under my bed, but there's a risk to keeping all that money under my bed too, and that is I'll never have any growth. And sometimes it's a proposition of how much money you can, if somebody's very nervous, say, why don't we take 10% of your money and put it to work rather than 100%? And let's put the rest of the other 90% in savings or something like that. And that sometimes works really well, is when you balance it out. But you've always, to reflect on what you've done, a lot of times you don't see couples in harmony. And I look at you and your wife, and you two both discuss issues together on your investing. You respect one another's opinions. And usually you come to some sort of consensus on what you want to do.
We usually do.
Yeah. And if you don't, then that's a good argument to say, we're just going to leave this alone. We're not going to go down that road, because
Leave it the way it is.
Leave it the way it is. And that's sometimes the right thing to do.
What do you think about this practice of before people get married, they have some legal paper where their finances are theirs and they don't ever go to the spouse, the future spouse?
Yeah.
What do they call that?
It's a prenuptial agreement.
That's it.
Well, I'm a romantic, and I just think it takes a little bit of the luster off. But I see it happening. I see it happening more often in older marriages when couples have are remarrying or they're in their 50s. You know, it says, I really trust you, except if I don't trust you, we got this document ready to go into place. But there's a lot of times, you know, a couple will get married later in life, and one spouse wants to protect some of their assets for their children. You know, they're saying, you know, I want to take care of you, but I also want to make sure that my children are taken care of.
From a previous marriage, perhaps, that would make sense.
Absolutely. And that's, you can understand that. You
Yeah.
really can. And you know, I don't know what, you probably know better than I do, but the incidence of marriages now in the 50s is probably going up because divorce or the loss of a spouse, and people want to get remarried. And that's always an interesting thing to work with people that are remarrying, because a lot of times they've gotten used to doing something a certain way, and they need to be cognizant of now we have to deal with one another together, and we have to work that out. Sometimes it's good for them to go as a couple and talk to somebody. And it may be an accountant, it may be a lawyer, it may be anybody, but it's not a bad idea to do it.
Save time.
I think we have about 3 minutes is what I'm hearing. So,
You want to sum up in any way at all, especially what we've been
well,
talking about?
I think everybody has to deal with this, whether you know you're investing or not, because in most cases people are investing through work, through the retirement plan. I think it's good to have goals. I think it's good to have a realistic idea of when you can afford to retire. And it's a good idea to have a handle on how you're investing your money, and not be afraid to talk to someone else who might know more than you do, but be clear on what you want from that person. Say, I need you to help me understand some of this stuff. The other thing that's important to keep in mind is there are lots of ways to learn about investments that are not a huge investment of time, and we'll explain to you in a very good way how these things work. And take advantage of those. If your office or your company's offering an education class on saving for retirement, go to the class. You know, we typically do large numbers of educational programs, and we get a very low percentage. And we try to figure out what are we doing wrong, but we're constantly trying to reinvent that to see if we can do a better job. People need to take advantage of it. But I've enjoyed being here today. It's always good to see you.
Good to see you, Pat. Really, I've wanted to have you here for a long time.
Well, anytime. You know that.
There was a broker, I will not mention whom, I asked him once to come on the show, and he said he would have to get permission from the corporate headquarters.
Right.
And ultimately, he never came on the show because of that. I salute you that
Thank you very much.
you don't have to have corporate headquarters permission.
Well, you have to get a little permission, but it's you know, this is what we do. And I haven't told you any deep, dark secrets about investing, and a lot of it's just common sense.
Well, I can't imagine in my fantasy what a corporate office would be afraid you're going to divulge or say.
It varies company to company, but we'll see. But thank you again for having me.
Thank you for being here, Pat.
I enjoyed it.
Our time is gone.
Yes, went fast.
It always goes too fast
does.
for my purposes.
Thanks, Lee.
Thank you. Thank you.